Maverick traders, welcome out to your FX and crypto midweek. It's nice to be here with you. May 31st, 2023. We close out another month. As they say, the days are long, but the years go by fast, and that is certainly true of 2023 so far. So let's dive into it and talk about what's moving in the markets. No surprise to all of you that join me each week, major changes in my outlook. Huge changes, 180 type changes in my outlook. So I've maintained this bullish outlook. Hey, markets are going higher. Equities look like they're cupping handles. Big extended moves should happen, big blow off tops. It didn't materialize as much in the S&P as it did in the NASDAQ, but that sort of makes sense. The NASDAQ has been the driver for the majority of the market gains. When you think about the stock market going up in 2023, it has been the Apples and Amazons and Microsofts of the world, large cap tech names in general. So that's signaling the big exhaustion blow off top. And remember, when we look at equities, when we're thinking about stocks, they are a risk asset in the purest sense. They are much more of a risk asset than any currency out there, than anything in that regard, because we're trading FX and we're trading crypto and we're trading these different markets. Well, those are currencies. That's relative value. How does the dollar stack up versus the euro? How does one look at investing in cryptocurrencies versus another cryptocurrency or versus the US dollar and so forth. But when we're thinking about stocks, they are just risk. It's ownership of a business. They're very cyclical. So as the economy goes through economic cycles where you have growth periods and then you have recessionary periods and so forth, these stocks will fill that, and you can overlay. I mean, it's a very near correlation if you look at the unemployment rate. When the unemployment rate is going up and people are losing jobs, so unemployment is getting worse, stocks are doing this, right? They're a reflection of that. And when people are getting jobs and the unemployment rate is going down, stocks are usually doing quite well. They are just such a good risk gauge. And they will pinpoint some major turning points, and that's where I think we're at. So I'm going to spend some time. We don't look at the NASDAQ every week, but I'm certainly going to look at the NASDAQ and we'll paint a picture there. So what's my rotation? I think in terms of other markets as well, I'm going more risk off. And this risk off there's different styles of risk off. There's banking crisis risk off versus economic downturn risk off, right? There's different things that can happen that should be good for certain asset classes. Like when the little banking crisis hit and there were some runs and so forth, well, that is like perfect. I mean, picture perfect for things like gold and crypto. So if we think about gold and crypto, I mean, getting out of currency devaluations, getting out of bank collapses and so on, this is like the best argument for getting out of things that are related to the money supply and such and getting into a different form of money. But I'm not in, hey, the crisis is in banking or something like that. I think the next downturn is economic related. And sure, a lot of people have expected an economic downturn for quite some time, and they've been wrong in essence. The unemployment rate has continued to plunge, so more people employed. Spending hasn't been reduced. The housing market hasn't collapsed. All those calling for a massive recession last year were dead wrong. The year before that were dead wrong. So here I am sticking my neck out and saying, hey, I'm finally on board with this. And I think other people are giving up on it, and I'm finally there. I'm finally like, I actually think now we're going to go through an economic problematic period of time. When you think about the economy, there are so many driving forces, but certainly money supply is at the top of them, right? The availability to capital. Well, interest rates going up is not an immediate thing. The Fed raises interest rates, but look, did that negatively impact the consumer instantly? Was the consumer just like, oh, well, the Fed raised rates, we can never buy any? No. Most consumers, most people have locked in mortgages 30 years or whatever at very low interest rates. So they can spike interest rates, and sure, incrementally, I mean, there are at on the other end of the scale where some people didn't have a loan and they want to take out a mortgage. Was it more expensive for them? Yes, but the very fact that they're taking out a mortgage, even when it's more expensive, tells you that they've got some money and they can weather it for a while, right? So there's such a lag effect when it comes to these things. I don't know why people on television are so think it's so instantaneous. Oh, the Fed raised rates? Well, the economy's about to get hit. That's not how it works. Think about businesses. Businesses have a lot of debt. Absolutely. AT&T has a massive amount of debt. The Fed raises rates. Does that immediately hurt AT&T? And AT&T just can't pay their bills? Well, of course not. They've locked in their debt for many years, in many cases, or at least multiple years, at very low interest rates. So interest rates moving in the short term are not a problem. What becomes a problem is when it's sustained and when you start getting to maturity on debt for corporations, on maturity on debt for consumers. And all of a sudden, over time, it does become an issue because 3 years down the road, AT&T needs to roll out $20 billion worth of debt. And now the market is at a much higher interest rate, meaning they have to pay a lot more money in interest, which hurts their total profitability as a corporation. And now they start trying to maintain that, so they lay off some employees. But this is not instantaneous, people. This is something that plays out over the process of time, right? Now they're trying to maintain their profitability, but interest expense went up, so they may lay off some employees. Well, this is why I said the whole idea that the Fed was raising rates and the economy was going to crash and so on instantaneously is just it makes no sense. It just doesn't. If you take a step back and you just really look at the dominoes and you say, well, of course it's not instantaneous. All these things take time, but does it have an effect? You bet it does in over the process of years. Well, now we're going on 2 years of Fed rate hikes and all these sorts of things. And I think that inflation has become a bit entrenched worldwide. And that's a problem. If you're looking at Australia's numbers, they had CPI at 6.8 versus the 6.4% expected. If you're looking at here in the US, we're going to see some big drops over the next 2 months because June and July were so high last year. But still, it's just entrenched where we're going to stay at this higher, stickier level. And the Fed just can't cut rates until something breaks. They just can't do it. In fact, there's even arguments now that they're going to hike one more time. And when they had basically given guidance that they weren't. Some of these inflation numbers, these core inflation numbers, are just showing signs of being somewhat entrenched. And it's a problem, and they really can't solve it until some of these dominoes topple over. And when these dominoes topple over, well, it takes a long time. So I think we're entering into that phase. I mean, look, I try to give it as I see it. And you might agree, you might disagree. You might say Corey's out of his mind. He has no idea what he's talking about. And you might be right. But for the first time in a long time, I think we've reached these levels where both from a timing perspective and a technical perspective, um, we're entering a period of time here where we've got to be on guard for some risk on type of or risk off type of moves that are very likely to be coming. And that's a much more volatile market. Now the trader says, hooray, that's fantastic news. The human being in me says, well, it's terrible news if that's what's going to happen. A lot of people are going to lose jobs over the next couple of years. A lot of people are going to see some lower stock prices, are going to have some economic downturns and so on. I would be an advocate for saying, hey, over the next couple of years, it's going to be pretty dicey. So just be aware if I'm right, we're going to see much lower stock prices. We're going to see some really bad things in terms of economic conditions for a while. And will the Fed come in and start to cut rates eventually? I don't think it'll happen this year, personally. I know the market's pricing in multiple rate cuts later this year. I don't see it. I think we're higher for longer on the rate side. And it is going to be over the process of time, but man, I would look at your own personal situation. Make sure you have some rainy day funds. Make sure you have some things. I think it's going to get a little ugly for a little while. So, not to sound so depressed and whatnot. I mean, look, I've been an optimist and I've said there will come a day where I'm going to flip the switch and I'm going to feel like we've entered that phase where the economy is going to take a downturn and we're going to start to see unemployment going the wrong way and we're really going to see some changes in these things, and it's not going to be great for markets and it's not going to be great for a lot of consumers and just individuals generally, but it's what I think is going to transpire over the next couple of years. So it is what it is. I just try to call it as I see it. I'm not a perma bull. I'm not a perma bear. If you look at the last few weeks, I've maintained, excuse me, I've maintained a bullish outlook and an upside expectation for markets. And now I think we've got to change that outlook. So let's come over here and make sense of this together. I really think some of your signals were essentially the end of the debt ceiling, quote unquote good news, because they've come to some resolutions and so on. People realized it looked like the deal was coming together at the end of last week, and the markets were rallying into that after a little downtick at the start of last week. And you just saw this flurry finish in the NASDAQ on quote unquote good news. We should now start to turn down. I think we'll see a CPI number coming out here in a week or two. Again, it's going to take a big annualized drop. And again, these things are probably in the quote unquote good news when it really looks like you're going to hear a lot about soft landings and that the Fed is maybe thread the needle and we're not going to have an economic recession and so on. And it's probably at exactly the wrong time for them to be saying such things. The S&P down about 1% so far this week. International stocks a little worse, down 1.5%. Crypto down 3%. Gold up 1%. Oil down 5%. Again, you would think that with a risk off, we would be all on board with buying crypto or something like that. And I worry, I don't think that that's the environment we're in. We're not in something that's perfect for crypto, because if the economy's down, going to take a leg lower and there's just less supply of capital and so on, this is more of a risk on asset from that standpoint. Now, if it was a banking crisis, I'd say get long crypto. If it was a US dollar, they're printing money. If it was something that was related to a financial crisis or something, maybe so. But since it's economically sensitive and such, I would actually expect crypto to go lower right along with risk assets. So I just am not, I can't pound the table that that's a great place to hide out. Oddly enough, just playing the short side on so many of these things is probably going to be the best way to make money. So as we look at the S&P, you don't get quite the sense. You don't see as much of a blow off top. Certainly a little bit of curvature, but that's not really it. But look at the tail end of this and then compare that to the NASDAQ. And I think the NASDAQ is key. So the NASDAQ has been the place to be and really driving this. And you can see it in this chart. Here was the breakout Here's the continuation, the stage 3, right? Buy the dips and such. And then you get the parabolic last gasp, exhaustive move, the big spikes in volume that correlate with here was the start of the race, you sprint for the finish line and such. And that's what it looks like to me. I suspect that this is that exhaustion high to where we're going to back and feel. We're going to see, expect some choppiness in here. It's not like I'm kind of sending this negative message. That's more of a message for the progression of markets over the long term. Do I think that we're going to see a pretty good sized, pretty dramatic downturn in stocks generally? I do. I think there's quite a bit of downside in the stock market overall. I think there's quite a bit of opportunity in terms of playing that environment and getting risk off and such. So it'll be case by case, but we'll have opportunities certainly to trade that. NASDAQ just did a really good job of showing that full, exhaustive blow off top, all the things we talked about. So this week, we're already starting to see it. Japanese yen, which is as risk off a currency as it gets, up 1%. And I'd expect more of the same. I'm quite interested in playing the Japanese yen. I'd almost say for the rest of this year. I'd almost say for the next couple of years. I cautioned against being short the yen at the end of last year, and it was right before the yen did this crazy upside move. Not that I predicted that, but there were some weird things happening within their central bank and such. So it was just not the right place to be short. A couple of months ago, where I really thought the markets were going to rally for a while, again, I didn't want to buy the yen right there and said, well, you could probably play it to the downside. We didn't really have any. Here I come back to the message I had last year. Late last year, I said I do not want to be short the yen. Here I'm back to that message. You could have shorted it the past couple of months, had my blessing, fine. I didn't see any reason to necessarily uh, avoid it or whatnot. Here I do. I think I don't want to be short the yen at all. So I'm thinking I'm buying the yen versus other things for the foreseeable future. I might short the Aussie against the yen. I might short the Kiwi. I might short the pound. I might short all sorts of things. But I do not want to be short the yen for the foreseeable future. And if I had to guess that from about this point on, well, end of last week type of thing on, I'd expect the yen to be probably the best performer for the rest of this year. That doesn't really show up as much on the charts yet, but I think it sort of does if you look at it on the flip side of the NASDAQ, where maybe it had its blow off bottom and now we can start to really recover in the yen itself for, again, I think it's going to be months, maybe even the next couple of years. Now, crypto, this is not the environment where crypto shines because it's more economic related. It's a lack of capital. When you have credit tightening standards, there's just less to be loaned. There's less capital readily available. I mean, that's the nature of what hiking and cutting rates and so forth is. When they hike rates, they're making capital less available. It's a money tightening process. When they cut rates, it makes money more easily accessible, more of it drives economic activity and so on. And we're in a rate hiking, credit tightening cycle, and that's, again, just not a great environment for crypto generally from a fundamental perspective. Where did crypto shine? It shined when they just went crazy with money printing. And when money printing got at its worst, crypto did its best. Now we're in a money tightening scenario, so no surprise to me, crypto's having a rough time. For me, are you above these moving averages and such? Yes, but I'm going red, I'm going red, I'm going red. just really changing my outlook from what it's been over the last couple of months. I am no longer the bull that expects prices to go higher and things to be really good. I think we're in trouble for a while. Here's the international markets. Now, you're in a channel, you're moving towards the bottom of the channel. I worry and suspect that maybe you're moving out of the bottom of that channel in the coming weeks. Again, equities are going to be pressured lower, is my thought. Crypto, I don't think it's a place that will flourish. It'll have some choppiness. It can go through periods of uptrends throughout this year, but generally speaking, in a credit tightening cycle out of this type of consolidation, I think the next phase is a whole nother multi-wave pattern to the downside. So I wish I could say something better, more positive, just not what I would anticipate is going to happen. For the rest of this week, we've got some non-farm payrolls coming out on Friday. These employment numbers, I circled, there's ADP, but these employment numbers, I think you're going to continue to see them trending lower, where we're going to start to see this for the next few months, that corporations, they're not mentioning inflation anymore. See, corporations at first can do some tricks to stay profitable. Again, this is why things move slowly in terms of economics. When you think about the economy and inflation and all these sorts of things, well, what do companies do? They say, well, we'll pull some tricks. We'll raise prices. Okay, the consumer won't pay those prices. Well, we'll sell it for the same price, but we'll start reducing how much is in the bag, right? Instead of it being 2 pounds, it'll be 1.7 pounds for the same price. And they'll do these tricks, but at a certain point, those tricks run out and inflation stalls. They start cutting employees. You're seeing that. You're seeing that starting to materialize. Average hourly earnings, I think you're going to continue to see that starting to take that downturn. And it wasn't instantaneous. It took well over a year, I think, for some of these things to start having a true impact. And it's going to continue in the coming months. So those non-farm payrolls and different numbers, I would expect we're going to see a real turn where they're going to start to turn a little bit more bearish in the coming months. And I don't know what the next true quote-unquote crisis will be per se, but I suspect we're going to enter into some phase where we're going to look back at this high and say, wow, look at how good stocks looked back there. And look at how lousy they look since then. I don't know exactly how it will look, but I suspect it's quite a bit lower. So let's make some sense of various crypto charts, or cryptos and FX charts. First, we'll start with the US dollar. Give credit where credit is due. US dollar looks about as good as you can look. No surprise, kind of stalled there. You probably see it before I mention it if you spent some time with me. This is a classic pattern. You've gone back. This was a major resistance. It's now being retested. You can see the formation that it's gone through. How big's the handle? Usually about 30% of the size of the cup. So the cup is 118.50 to 123.50. That's how big the cup is. The handle will usually be about 30% of that. So let's just pull up a calculator and do it for fun together. 1.2350 minus 1.1850 equals 0.0500 times 0.3, which is 30%. You get about 150 decline. So from about 123.50, you drop 150, you go to about 122. The next move, in my estimation, is a pullback in USD to about 122. and then we should go back to the resistance again. Can you be a buyer of USD? Not right here, but right about there, I would absolutely positively look at it as being a buyer. This is what I call painting a picture, where you got to have some outlook and expectation so that you know if the market is following or is not following that outlook. And that's where risk management and all these things come into play. If I enter at 122 and it doesn't hold, and for whatever reason it starts breaking down, well, I bail out, right? If it does hold, I can target a move here, and I can even make an educated assessment that the size of this can be a projection up to here, and this thing could go all the way back to 125, another 150 points even higher than that. So in terms of the expectation for where these things will go, I think a move towards, well, first down in the USD, but man, that can create a nice buying opportunity. Let's look at the Japanese yen. Japanese yen, I would compare this to the NASDAQ in reverse. Every step that the NASDAQ was screaming higher, the yen was going lower. And that makes sense, right? There's risk being taken, things are getting better, stocks are going up, yen should suffer. That's typical. NASDAQ hits its highs, exhaustion high right there. The NASDAQ's fallen back a little bit the last 1 or 2 days. The yen's finally catching a bid. Would I buy it aggressively as it's trying to break higher here? No, it's got a lot of overhead supply. But as we get these little dips and things, you'll get a little dip. You'll get them constantly. And I'll look to buy the yen. And as it runs higher and consolidates and so on, I'll buy some of these dips. And I'll just try to look at those pairs where I'm shorting pound yen and I'm shorting euro yen and I'm shorting Aussie yen and whatever, but I am buying the yen. And I think, again, it doesn't really make as much sense technically, because you're like, Corey, you're buying in a downtrend. Well, I am, but I think the bottom's in. I think the top's in markets. So I'm selling rallies in equities. I'm buying dips in yen. I think that's the trade for the foreseeable future. It's as much fundamental as it is technical, but it's both. I think we've seen that exhaustion high, and it's the same reason that I can be bullish over the past few months as everyone else is negative and so forth. I try to marry these things and really look at the full picture. There's fundamentals, there's technicals, there's sentiment, and all of them play a role. Sometimes when you just get so locked into the charts, you're not seeing the full picture, because if I look at this chart, I just say, well, you just got to keep shorting it, right? But I don't think that's the right trade at all. And the last 2 days, if you'd been short yen, you'd have gotten your face ripped off. So I think there's a time and a place for everything. I think yen goes wildly higher over the next few months. Let's look at the euro chart. Mixed bag. The euro has been more moving to the beat of its own drum. I would give the Swiss franc a little bit more of a defensive quality and the euro less so. But euro, just sort of hard to make a determination. We set an exhaustion high here. Look at the big bullish candle. It kind of finished off this move, big punctuation mark. And then we dropped hard, and now we're just choppy, and the moving averages are mixed and going sideways. I don't know that I have a strong opinion either way. Swiss franc, again, I would give this a little bit of more credence towards an upside move because it's more defensive. So where I think the euro maybe doesn't hold up quite as well, I would have a tendency to bet that the Swiss franc can be one of the better currencies over the next couple of months. So we'll see if that can hold. Little mini cup and handle maybe, or ascending triangle forming here, whatever you want to call it. A little more bullish. I would I would say, on the Swiss franc. British pound still strong. Went through a consolidative period, broke out again, looks solid. Still in pound. CAD. CAD's interesting. I've liked CAD. We highlighted this. I mean, what better time to buy CAD than right there on that dip we talked about? I did the market roundup on Monday of last week. So it was, what is that, 9 days ago? Something like that. It was literally right there. I was covering for Onkit, and I said, this is the trade, this is the buy, this is the opportunity. And wow, what a great environment. If you had told me how bad oil would do over that period, I'd say, well, probably didn't work out quite as much as I would have hoped and expected. But it's not always perfectly correlated to oil, first of all. It's much more correlated to just obviously the Canadian economy and other things, but there tends to be a correlation. This one broke out. So, again, whether you liked it as like the cup and handle or the ascending triangle, we said patterns within patterns, and it should be a good one. Now, here's the bad news. What's the bad news? Well, the bad news is that if I look at this little trading range, this little dip, and project it on top, guess what's happened? We've achieved the target, the exact target you'd expect on a breakout. So what's the next step? Well, probably a pullback. And maybe we come back to that old breakout point. Maybe we break below it. Maybe it gets ugly here for a while in CAD. I don't know, but I would certainly be a profit taker on this big candle up here, thinking that, again, the size of this projected up there is really what you'd have anticipated, and it's achieved those and had sort of a blow off top type of phase. A big bullish candle like this, can it lead to more upside? It could, but generally speaking, that will be when it's hitting resistance and your price targets is just a good place to take profits. Much less of a short, I would say, though. I wouldn't short the CAD here, but a take profit makes sense. Now, Aussie is a short. It just is. It's descending triangle, ready to break down. I would anticipate it can, it will. Just does not look right, right? And then Kiwi also much weaker than it would have, could have, should have been. We like this one here on a retest of that trend line. And then the RBNZ, man, the RBNZ derailed this thing. We tried to short the Kiwi on it, and we should have just kept chasing. That was a case where I don't really chase things. If they don't hit my criteria, I just say, well, I missed that one. And that's what happened. We tried to short the Kiwi, and it just took off without us, plain and simple. But look at it since then. That has plunged all the way back here to the support. So does it bounce? Probably, and then fails all over again. We have moved into a risk-off environment, and I think you're seeing that across currencies. You're seeing that turn happening right before our eyes. Let's come over here to crypto, as we said. A little bit more bearish in the group. If we look at Bitcoin individually, look, this is bearish chart pattern. 20s below the 50. We've got downward slope. We recently failed against the 50-period moving average. We should head lower into new lows. Bitcoin Cash, not better. You know, it's just pretty much the same or worse. Ethereum, really a false breakout. Now it's plunging. Still looks like a short. Litecoin, it had a great run back in here and still likely to fail, I think. Likely to continue to see lower prices. So I suppose you can say Litecoin's the best of them, but that doesn't give you a real strong indication of bullishness because you still have at best kind of a mixed sideways to neutral signal in Litecoin, which is the best of the bunch. As a group, still look pretty bad. Good question. What yen pairs to short? Well, I think almost all of them against it, but in the short term, it would be aggressive, but we know that the USD look like it's gonna it's if it's in that big cup and handle, it's gonna fall for a few days. So you could even, look at something like USD yen in shorter term charts. Euro yen, still those are a little bit more bullish. CAD yen, a little bit more bullish. Now as we get into the more bearish candidates, these would be the more obvious two. Aussie yen and Kiwi yen. Those to me are the two that just seem more logical, more backed by the charts, backed by the momentum, backed by a lot of things where you're buying the yen in a downtrend, and that's tough. So you got to pick on probably the weaklings on the other side. If I come into a 4-hour chart of Aussie yen, I just start to pick my spots and say, okay, where does it bounce to, and how do I trade it? If maybe we come up underneath this and bounce for a few periods, I can short against that, right, for the next wave to the downside. If I come into Kiwi yens, the same type of concept. You're using the bounces. You could have already been short. You're using these bear rally patterns to get short things against the yen. So Aussie yen and Kiwi yen would be the two most obvious candidates. You're sort of trading things that have been bearish against other things that have been bearish, which gives you a better. If you're going to try to buy the Japanese yen, which has been in a downtrend, at least do it against something else that's been in a downtrend. And then, like any FX, you're playing relative value. They've both been bad. I think this one's going to be better than this one in the near term. I think, you know, Aussie and Japanese yen have both been terrible, but I think this one's going to be better than this one going forward. So that would be the most obvious from just a pure relative strength, relative weakness perspective. But if you follow my thought process, I'm gonna probably be a little more negative for a while. So yeah, for those that got sick of me saying keep buying, and playing risk on for the past couple of months, well, now you get sick of me saying be negative and play risk off and keep buying yen and keep shorting things against it and so forth. So you'll get to hear that message, I'm guessing, for the next few months. And if you are hearing that message, it means that message is working. It's resonating. Those trends are continuing to progress, and there's money to be made. So, hope you've enjoyed this week's midweek. Have a great rest of your week. If there's ever anything we can do to help, don't hesitate to ask, and we can add it. If you want to look at different currencies and things, we're always happy to do that. So thanks for your request today. We will see you next week. Same time, same place, my friends. Goodbye, everyone.